Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter. I'm the funds editor on the Investors Chronicle. And today I'm very happy to be joined by Sam Gleave, one of the managers of the Liontrust European Dynamic Fund. Sam, thanks for coming in. How are you doing?
I'm very well, thank you, Dave. Thank you for having me. Pleasure to be here.
So obviously you have a very specific process in the fund and focus on kind of individual companies, but Europe is often a region that has many kind of external factors that have to be, I suppose, considered when you're investing. So I thought, first of all, it'd be interesting to get your kind of take on perhaps what the outlook is in 2025. What are the maybe kind of key trends that you have to keep an eye on? And, whether there are any potentially interesting or potentially even, off-putting sectors. A lot in that question, but just your general take to kick off.
So I think we're overall still bullish on the outlook for European equity markets. I would say we are moderately bullish, and there's a couple of reasons for that. So, first of all, when you look at valuation of European stock markets, we think they're reasonably valued. They're not particularly expensive at all. We also see an encouraging sign on corporate behavior. So we're not seeing signs of poor investment decision making by corporates. Typically, that's quite a positive sign for future stock market performance. So there are a couple of factors we feel to really be quite optimistic about the outlook for Europe. Of course, there are some more negative economic headlines. But generally, those economic headlines are widely known. We've been reading about them for the last couple of years. For example, weaker growth in Germany, weaker growth or political instability in some countries in Europe, such as France. So I think those risks are sort of discounted into market valuation. And in fact, there could be a number of positive catalysts that emerge for the outlook for European equities over the next 12 months. So, for example, political change in Germany, where there might be focus on less regulation, which we think would be positive. China is an important sort of exporting country for European stocks, and we think there could be more stimulus from the Chinese government this year, and we think that would be another positive catalyst for European companies that do export to that region.
And what are the interesting kind of, I suppose, China plays if you're looking within the European market? Is it those kind of luxury brands or what's kind of standing out?
Yes, so definitely some of the luxury stocks have exposure to China, and that has been a bit of a headwind for them in the last sort of 12 to 18 months. And they've also faced some FX headwinds on that front as well. But generally, some of the luxury stocks are actually holding up pretty well. And we do own one or two of them in our European funds today. Perhaps we can come on to that in a moment. So generally, I think if there's any sort of recovery in growth for the Chinese consumer, I think luxury stocks should benefit from that. I also think that industrial stocks will benefit from that. If you think of, some of the key industrial companies in Europe, they do export a lot to China, and that has been quite a significant headwind for them over the last 1 to 2 years. Their valuations are quite low, so we think that actually could be a positive surprise over the next 12 to 24 months. But I think it probably will take some time to play out.
And what sorts of kind of industrial names have been kind of standing out?
So I'm sure a lot of your readers and listeners will have heard about the sort of the problems for automakers in Europe. We saw some quite significant downgrades for a number of the autos during the course of sort of summer of 2024 and really across the second half of 2024. Not all of them, but for some of them. And I think if we saw a recovery in some growth coming through in China, I think, for example, that should be positive for the automakers.
Mm. And we briefly touched on the kind of luxury names.
In the luxury goods sector, we do own and have owned for some time Hermes. So that's the Paris listed luxury goods company. It is a cash flow champion. It generates a very high cash return on capital score, one of the key metrics that we look for in our investment process. And it's really been a recurring cash flow champion for a number of years. We also are attracted to that company because of its family shareholding. So the family still have a large shareholding in the business. And we quite often find that companies with a large family shareholding have a really strong focus on cash generation in their business and actually quite a prudent approach to how they then deploy that cash. So we think that Hermes is a very well run business. It's a very cash generative business, so it can self fund its own expansion. For example, expanding its store network and its product range, but it can also return a lot of cash to shareholders. I think at the moment it's sitting with about net cash of 11 billion euros on its balance sheet. So Hermes is a good example of what we call a cash flow champion. They've actually stood up to the slowdown in China quite well and have still been delivering through 2024 sort of low double-digit organic growth. And we expect that to continue.
Are there many other of those kind of family stories? I suppose that's still kind of a theme that lots of fund managers are very keen on. But in Europe, are there many other kind of notable names that perhaps you hold or?
Just thinking across our European portfolio, at the moment, not too many, but it certainly is a theme. For example, Moncler, another sort of smaller luxury goods, there's a sort of significant founder stake in that business, and we own that in one of our other funds. It's been performing pretty robustly as well, and is also what we call a cash flow champion.
I suppose are those kind of stocks also a bit less vulnerable to kind of M&A activity and that kind of thing, or is that too
S-
generalistic a take? Or
Certainly, given the size of Hermes, that's probably quite unlikely.
mm,
And we also assume that the family would like to maintain the independence of that business.
mm,
Never say never, but I think
yeah,
relatively unlikely.
yeah. I suppose if I think about the UK market, obviously some of the big themes in the last year or two or so, maybe a bit longer, have been, I guess, A, kind of lots of buybacks, but B, lots of M&A activity. Is that something that you're also seeing when you turn to the European market, or is it kind of a bit different? And if so, how does that have a bearing on the kind of portfolio?
I would say in recent years, M&A activity in Eurozone has been relatively low. Um, of late, there have been a few pockets of M&A emerging. For example, Italian banks, and in fact,
Mm,
just this morning, we had the announcement from Montepaschi Bank that it had made an all-share offer for Mediobanca. So there are pockets of M&A emerging.
mm,
We do think that given the valuation of European stocks, that they look quite attractive. But I suppose some of the M&A purchasers on the buying side, private equity, they've found some really quite attractive opportunities, some really cheap opportunities in the UK, and
mm.
perhaps that's been their focus over the last couple of years.
Yeah, that would make sense. You mentioned banks, and I suppose there's that kind of narrative for banks is perhaps coming through a bit more. Um, but do you have any concerns about kind of the relative advantage of like US peers versus the European banks, given there's now, I suppose, the prospects of kind of deregulation coming down the line?
I think that's true that certainly the US banks may enjoy a sort of more deregulation versus the European banks. And I think that's something that European regulators have to review. I think European banks are in a very different position today than they were sort of in the aftermath of the financial crisis back in 2008, and where they had a sort of decade of underperformance and they were really out of favor.
Mm,
Today, when you look at European banks, we see a number of positives. In fact, it's one of the larger overweight positions in our European fund today. And it's been like that for the last couple of years, and we still have that position today. And the reason we're positive on banks is that when you compare their level of net income versus their market valuation, we think they actually look quite cheap. So many of the banks are also still trading at a discount to book value.
Mm.
They're also enjoying better earnings growth. And also, very importantly, the asset quality, the balance sheets of these banks have improved. The non-performing loans, generally that number is quite low. Increasingly, banks in Europe are generating higher surplus capital. And that's really positive from a shareholder perspective because it means that in the future, returns to shareholders should be higher. So, for example, UniCredit, one of our larger holdings in our European fund, the Italian bank, it's enjoyed, under a new CEO, quite significant growth in the last couple of years, quite a lot of restructuring. Its valuation is still attractive. It's got a strong balance sheet, and we would expect a further share buyback announcement.
Mm.
There is speculation of a potential acquisition of Commerzbank with that stock. If that does happen, we'll review the position of that stock. There are also, amongst our banks' exposure in Europe, a number of self-help stories, sort of restructuring stories. So another holding in our European Dynamic Fund is Deutsche Bank,
Mm.
and that was an unloved stock, really, really out of favor for many, many years due to sort of a very low return on income score, and prompted by quite significant management change and a new CEO. You've seen a lot of restructuring at Deutsche Bank. We bought it in the second half of 2023 on a very low valuation. The stock has re-rated somewhat since then, but actually is still sitting at about a 30% discount to book value.
Mm.
They are gradually sorting out some of the sort of legacy problems that business has had. They are increasingly generating more excess capital, and at their results due next month, their full year 2024 results, there is the possibility of a share buyback announcement.
Mm.
So there's a number of generally strong earnings growth stories at banks in Europe, but also some quite interesting self-help and restructuring stories, such as
Mm.
Deutsche Bank. UBS is another one. Obviously, the integration of Credit Suisse is critical. We think there could be quite significant upside that still emerges from that transaction.
Mm.
And obviously, UBS has a very strong global wealth management franchise as well.
I wanted to turn back to, I suppose, a couple of the other kind of stocks that in Europe that people pay a lot of attention to. One of them, very topical, is kind of Novo Nordisk. Huge market darling, but then in recent months things have been a bit trickier. You have the kind of disappointing trial results towards the back end of the year. Shares have slipped quite a lot. What's your kind of take on that company now?
So perhaps just a little bit of brief history on our ownership of that stock.
Mm.
So we bought that stock a number of years ago, and it has been a very strong cash flow champion. So
Mm.
generating a lot of cash versus its asset base, enjoying very positive business momentum, able to self-fund this growth and returning a lot of cash to shareholders via very strong growth in its dividend and also buying back its own shares. So the story has been very positive for a number of years. But as you said, a sort of market darling, um, a very big sort of consensus position as we progress through 2024. Our investment screens actually picked up some more cautious data on Novo Nordisk in the second half of 2024, and we actually trimmed our position at that point in the stock. In fact, it's the only stock, it's one of the sort of much smaller positions we have in our fund today, and it's the only stock that we own in the fund relative to its benchmark that we're underweight.
Mm.
So they've got a results, full year 2024 results coming up next month, and we'll sort of monitor all of that data closely. But generally, we were concerned by quite significant growth in CapEx. So,
Mm.
for example, the company had to invest in production facilities for the supply of these new weight loss drugs to fulfill demand. So that was a bit of a drain on their cash resources, and we also noticed some modest deterioration in some of their working capital components.
Mm.
Our investment process really focuses on the financial evidence and all the detail in the cash flow statement and the balance sheet.
Mm.
So we monitor all of that data very, very closely. So we noticed that some of that data had deteriorated slightly for Novo Nordisk in the second half of last year, hence the trimming of that position. And we'll review that position again after they publish their full year numbers in the next week or two.
Yeah, yeah. I suppose there are interesting different takes on that stock because, for example, one more qualitative argument for it is that its drug discovery process is quite different and quite innovative, and therefore they could potentially, come up with some new wonder product or something that again sort of propels returns. But yeah,
That's absolutely correct. I mean, it's
mm,
absolutely at the forefront of research and development in Europe in various treatments. So, absolutely, I suppose that alongside that R&D process, when you have successful drug trials, you then have to fulfill demand, and that requires investment in supply and production, etc.
mm,
So, that does take a number of years. And from an investor perspective, we have to think about, well, what is already discounted in the share price
yeah,
and what does its valuation look like? Because the stock market is always looking ahead.
mm,
So for the time being, we have an underweight position in that stock, and as I said, we'll review it again post the full year 2024 numbers.
makes sense.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
And turning to a completely different market, darling, what's your view on ASML?
This is an interesting one from our investment process perspective. So a bit like Novo Nordisk had been a recurring cash flow champion for a number of years. So what we would call a quality growth stock, generating a lot of cash versus its asset base, also enjoying very strong business momentum, self-funding its own growth and returning lots of cash to shareholders. So over the last few years, a sort of similar profile in a way to Novo Nordisk, despite being in a different sector. However, we sold it last summer because from our investment process perspective, we noticed a deterioration in some cash flow scores. So in order to fulfill customer demand, and obviously the very significant AI theme, for example, the company has had to invest quite significantly. So we saw quite a significant increase in its capex.
Mm,
We also saw a deterioration in some of the working capital components as well
yeah.
for this stock. The valuation was still quite expensive. So we decided to sell out of that stock,
Mm.
and we sold it from all of our portfolios in the summer of last year. So we currently still don't own it. We may well own it in the future, just not at this point.
And how do you, I mean, obviously, as you mentioned, you have a very set kind of process and look at the kind of numbers. But I suppose one thing that European investors can't really ignore so much is what's going to happen with Trump and the idea of tariffs and that kind of thing. Is that kind of having a bearing on the funds? Like, how do you kind of account for, obviously, we don't really know yet what's happening.
So certainly political announcements or speculation of sort of political announcements from Trump does contribute to volatility. So I think on a very, very short term basis, that contributes to volatility in European funds on a day to day basis. I do think, though, however, you have to sort of look at the potential tariff risk quite closely. And obviously, for European companies that have big manufacturing plants in the US, they should be protected from tariffs.
Mm,
But there will be some European companies that, if tariffs emerge, will be more exposed. At this point in time, we haven't heard anything concrete from Trump on that front. But obviously, that's something that we have to be mindful of and watch quite closely. There are a number of European companies that, for example, they're listed in Europe, but actually they have quite a lot of exposure to the US. And the US economy is growing pretty robustly. So actually, these European companies should benefit from their exposure to the US. Names such as Saint-Gobain, the French listed building materials company, is just one example.
Mm.
Or Publicis, the media company.
Yeah.
2/3 of its revenues are generated in the US.
Yeah. I was going to ask about Publicis on a sort of different note because a couple of its big rivals are set to merge. What are your kind of thoughts on that? Does that have any bearing on the kind of investment case?
Yeah, so we've owned Publicis in our European Dynamic Fund for a number of years, and we bought it very cheaply, sort of in the middle of the COVID crisis. And since then, we've seen organic growth at the company recover quite strongly. The potential merger of Interpublic and Omnicom potentially poses some challenges to Publicis, but also some opportunities. That is a very large and complicated potential merger. That may result in some opportunities for Publicis. For example, the management teams of Interpublic and Omnicom will have to concentrate on execution. It's always execution risk, particularly on a merger of that scale. There could be some business retention opportunities as well for Publicis if management have to focus on execution and in fact they lose some business. So that could be an opportunity for Publicis. And it does remind me actually of the potential merger that was announced back in 2013 of Publicis and Omnicom.
Mm.
And that, as you probably know, fell through in 2014. And I think the reasons for that fallout were due to, not being really able to align corporate cultures and management philosophy and business retention risk. So these large scale mergers do come with quite a lot of risk. And that may be an opportunity for Publicis.
Interesting. And otherwise, given what we've discussed in terms of the outlook and the backdrop in Europe, are there any sectors at the minute that you're being more kind of wary on, or that are perhaps meeting your requirements, less than others, that kind of thing?
So today in our fund, if I look at sort of the largest overweight and underweight positions by sector, sort of the key three overweights are financials, we've mentioned consumer discretionary and industrials. And some of the key underweights we have are healthcare and consumer staples and IT. And the reason for those underweight positions is that we have a very strict, disciplined investment process with a clear framework of rules. And there just aren't many companies, for example, in the consumer staples sector, that at this point in time are getting onto our cash flow champions watch list. In other words, they're not quite cheap enough for the cash flow that they generate, or perhaps they're not quite generating a high enough cash flow relative to their asset base. We run high conviction, highly active funds. And so the bar is really quite high for good cash flow stocks.
How is that number, in terms of, I suppose, companies that meet that level, how has that changed over time? And is your kind of opportunity set growing, or?
The way we've constructed our investment process is that we rank stocks according to two cash flow ratios. We add together those two cash flow ratios for all stocks in the European investment universe, and we focus on the top 20%. So we're trying to, outperform a benchmark for a European dynamic fund. So we focus on that top 20%. And history clearly shows that stocks with strong cash flow characteristics typically outperform over the long term. What does change year in, year out can be the content of that top 20%. So, for example, there will be periods when material stocks or energy stocks or IT stocks appear in a bigger way, in a more significant way on that cash flow champions watch list. And there will be years when perhaps they don't appear at all. We follow the investment process. At the moment, there aren't many opportunities in the healthcare sector. We do own Novartis in our European Dynamic Fund, but we don't own some of the other sort of large cap pharmaceutical stocks in Europe, such as Roche and Sanofi, for example, at this point. And we also don't own many of the large consumer staple names in Europe at this point.
Yeah. And finally, what's your view on the kind of relative attractions at the minute? So I suppose kind of large caps, mid caps, that kind of thing. I think around, looks like around 63% as of the funds in large caps and 31, well, nearly 32% in mid caps.
That's correct. So perhaps just a little bit of information on that positioning. So we adopt in portfolio construction what we call an equally weighted approach at inception. So we buy, say, for example, of the 30 stocks in the portfolio, 3% of a new stock, regardless of its market cap. We think if we paid attention to market cap, that would bring in unintended valuation bias into the portfolio. That approach to portfolio construction means that we always have a negative size tilt versus the benchmark, but it's not because we don't own large cap names, which we do, as we've discussed, such as Hermes or Novo Nordisk. I would say that currently there is probably more of an opportunity in small and mid cap stocks. They have faced quite significant headwinds in recent years and have quite significantly underperformed.
Mm.
I think should interest rates in Eurozone generally continue to fall further,
Yeah.
then I think that would be the catalyst for small and mid cap stocks to outperform.
Well, lots of food for thought there, but unfortunately, that is all we have time for. So, Sam, would just like to thank you for your time and thank you to everyone for listening. Take care.
Thank you.